Hey everyone, Paul Clark here, and Southwest Airlines announced their earnings before the market opened today on 10/22, October 22nd, 2020, and they came out with their Q3 earnings results. And there were some good things about it, but there were also some bad things. So when you look at their earnings, or their loss rather, this is the biggest loss that Southwest has ever posted in their history. I mean, it was a really big number. They lost $1.2 billion. And if you look at just operating income, that was worse. Their operating income or operating loss was $1.4 billion. So that was pretty bad, but there were still some things to be positive about. And clearly investors were able to kind of look past the $1.2 billion loss, because this stock was actually up over 5% today. It closed at $41.93. And if we look back on the history of this stock, they actually had their low posted in May. And I know a lot of the kind of overselling earlier this year, a lot of the lows were in March. A lot of the airlines, they blew past the March lows and kept running, going lower all the way through May. But since that May bottom, Southwest Airlines is actually up over 75%. So they've done pretty well since that point in time. And, of course, with airlines, always the big concern is being able to navigate their high fixed costs. So, for some businesses, you can say, okay, you're able to control a lot of the variable costs, or variable costs make up a big part of the business. Very much not true with airlines. And, even if you have a plane that's half full, you're still flying the full plane, unfortunately. And that's a big reason why Warren Buffett sold the stock back when he did. That being said, I mean, clearly, at least so far, from the price he sold it at to where the prices are today, he would have been better off holding. But it remains to be seen how this thing actually plays out. So we said that there were some positives. Well, let's get into some of the positives right now. So if we look at this, so Southwest actually broke out their quarterly results by month. So if we look at July, August, and September, we can see how much their year-over-year sales have declined by. And it started out in July, their year-over-year sales declined by 70.6%. I mean, right, that's huge. But again, for the positive piece, in August, they declined by 68.5%, and in September, they declined year over year by 64.8%. So that has gotten better every month in the quarter when you compare it to the year over year trend. And we can specifically say that from July to August, that year over year trend got better by 2.1%, whereas the year over year trend from the 68.5 to the 64.8 got better by 3.7%. Okay, so again, down by massive numbers, trending in the right direction. And we also see that positivity, by the way, in the load factor. And the load factor basically just boils down to how full was the airplane. They're flying around people in here. So you look at the load factor in July and August, it was about 42%. In September, it was 51.5%. So strong growth. They've got a long way to go, no doubt about it, but seeing those positive trends is one of the things I think investors were excited about. Another thing that I think investors were excited about was the fact that this company, they've really kind of gone through many steps to ensure that they had liquidity to sustain their cash burn. And also when you look at their cash burn, it's actually been improving. Okay, so they're saying, hey, we're still losing money on a daily basis, but we're losing less money on a daily basis. And again, I feel like clearly investors found some positives in that as well. So the cash burn for the Q3 average was actually about $16 million a day, whereas in Q2 it was about $23 million a day. So we can see that it's an improvement of about $7 million a day with just one quarter. And by the way, so the other good positive thing just overall about Southwest is they have a lot more travelers in the leisure category. So, I think a lot of business travel could be delayed longer than people just wanting to get out in the sun and go on vacation and kind of get back to a little bit of normalcy. So because I think that's actually going to come back faster, and because Southwest's customer base is more composed of that customer segment, I think that's actually going to bode well for them as it relates to the other airlines they're competing against. And, you could also keep in mind that Southwest, by the way, is, at least based on 2019 data, they were the fourth largest airline in the United States. So ahead of them, you got the big three. You've got United, you got American, you got Delta. And, a lot of those, have significant international business as well, whereas Southwest, 2019, 97% of their business was domestic, just 3% of their flights taking place internationally, right? So the fact that they've got less international exposure, that certainly has been a help to Southwest being able to navigate this as well. Okay, so looking at the operating results, we can see that revenue in 2020 was about $1.8 billion, and that was down 68% from the $5.6 billion that took place for the 3 months in 2019. So again, with that 68% decline in sales, I've highlighted a couple of these in red here. So you'll notice, the salaries and wages, they're down 24%, okay, and that's a pretty big decline. They've been able to kind of control that a little bit, and they've done that through, really kind of being able to encourage people to, either retire early or people who wanted to leave. This company has really prioritized saying, hey, we don't want to furlough people, lay people off. We're, going to lead with that approach first. And, the government programs have actually helped them to be able to achieve that. And they're currently right now kind of, pleading with the government to be able to have additional funds because they don't want to furlough any employees as they're going through this process. Of course, a lot of that is a negotiating technique. And when you kind of look at it from one way, they have such a strong balance sheet, which of course they would like the additional funding. But when you look at their liquidity and the strength of their balance sheet, they're not in any kind of short-term dire need for government assistance. So I think that's part of the reason of the holdup. And of course, there's other political reasons, but that's a bit of it. But again, so you got the 68% decline in sales, 24% decline in salaries and wages, and that 24% does actually include, there was a voluntary figure that kind of got rolled up into that. And then we look at landing fees and airport rentals. That only declined by 11%. So the landing fees and airport rentals was $345 million in 2019, and it was $308 million in 2020. So only a decline of $7 million, and again, only 11%. And that's a big reason why they're experiencing such a high cash burn, is that they have some of these fixed costs that they really just can't get rid of. So it's kind of like the equivalent if you have a mortgage, like in the short run, you can't get rid of your mortgage, but you can get rid of cable, or you can get rid of maybe internet service or something along those lines. And that's a bit of what they're experiencing. So they've got these fixed costs that are still kind of weighing them down. And another big one here is the depreciation and amortization. So depreciation, that's not something, again, that they're going to be able to avoid in the short term. And that was a $315 million charge. And that was actually a 2% gain over last year, hurting against them. So when you add up all of their operating expenses in total, it actually was a decline year over year of 34%, which again, is kind of go back to showing that their operating expenses declined by 34%. That's it relative to the 68%. Big reason why they were posting a $1.4 billion net loss from an operating perspective. And again, that compares to in 2019 when they had an operating net income of $819 million. Okay, so now let's get into a little bit more of the details here. So we can take a look at some of the passenger information. We can take a look at some of the fuel costs and trips flown, things like that. So let's go ahead and get into that. So when we look at just the number of passengers who were paying customers in 2020 for this quarter, they had 11.6 million passengers that were paying to be on the plane. And then you had in 2019, 33.5 million. So that was a decline of 65%. And then we look at that in just in absolute terms. I mean, they had almost 22 million less people for the Q3 results that were on their planes. Okay, so definitely a big number. But then at the same time, you see the trips flown, And you understand that the trips flown actually only decreased by 34%. So they had 231,000 trips flown in 2020, as opposed to 348,000 trips flown for the quarter last year. We already talked about the load factor and how this was improving throughout the quarter. So the quarterly average was 45%, but again, most recently in September, it was that 51.5% that we had talked about a little earlier. But we compare that to the quarter in 2019, and it was 84%. So their load factor in total, it was down 39%. How about the average fare? So the prices were about 20% lower on average for what passengers were paying to be on these planes. So it was $125 in 2020 as opposed to $156. So then we get into the fuel cost, and I broke this out in a different way here. So with the fuel cost, we can see what the fuel cost was in 2020 and then 2019, and it was actually 43% less when they're looking at what they were paying per gallon. So it was $1.18 in 2020 for them. It was $2.07 last year. So, they were using less fuel, but then they were also paying less for the fuel that they were using. So they were kind of benefiting on the fuel cost line from both of those aspects. But you might ask yourself, okay, well, what if they had their same 2020 volume? What if they were spending the same or had consumed the same number of gallons? But what if they had to pay the 2019 prices? And I'm not saying that, of course, that we're just going to snap back to 2019 prices. I think that, if oil ever does fully recover, and it's not clear that it will, I don't expect that to be just a straight line back up. But, just out of curiosity, if they were actually saying that the 320 million gallons of gasoline they used in 2020 for this quarter, if that was applied at the $2.07 for their average fuel cost last year, they would have actually paid about $284 million more in fuel costs just from being able to pay that higher price or paying in 2019 gas prices. So the fact that gas prices alone from that per gallon decrease saved them $284 million certainly helped. But of course, that's a connected variable. I mean, the fact that demand was down overall, for travel and things like that was a huge reason why gas was down as much as what it was. So certainly if, demand would have been the same as 2019, you wouldn't have seen prices down as much. But as it was, that's how it worked out. And then at the bottom here, I've got a little note about their liquidity. So again, we had talked about the strength of their balance sheet. One of the positives I think investors were kind of looking at with their earnings. So the cash and short-term investments, they had $14.6 billion in cash on the balance sheet. And they also have a credit line available to them for $1 billion. So their total liquidity that management had talked about was actually $15.6 billion. But in terms of being able to say what their cash burn is, for illustrating this here, I wanted to just kind of say, hey, purely in cash. So we're going to look at the quarterly average in their cash burn. So on average, they're burning $16 million a day. So you might ask yourself, okay, you got $14.6 billion sitting on your balance sheet. You have a quarterly cash burn of $16 million. How many days would you be able to survive doing the math on those? And it'd be about 913 days. And again, that's a frame of reference. That's not, in any sense saying that that's truly what would happen. But again, you just look at their cash and short-term investments, look at their cash burn. It'd be over 900 days to be able to survive on that alone. Now, of course, there's really not an expectation that they're going to need to rely on it for that long. Again, we are seeing improving metrics, and in fact, some analysts are calling for the potential that Southwest could be profitable by the second half of 2021. And there's also kind of a bit of the expectation in the investment community. Analysts are saying that towards the end of 2020, that we're expecting Southwest to be at about 75% capacity relative to what it was in 2019. So again, talking about those trends, that would even further decrease their cash burn, eventually get the cash burn where they can actually start generating cash, and then that changes how long that they can survive. So with that in mind, the fact that they are positioned as strongly as what they are, they're positioned strong with the leisure consumer, they're positioned strong from saying, hey, they haven't actually even laid off any employees yet. They've kind of started to negotiate with the unions. This was in their earnings report as well. They've started negotiating with unions, saying that they want to help kind of get some of the wage costs down. and ultimately saying, hey, if we are not successful with the unions, we might have to turn to furloughs. So the fact that they have that additional lever to pull and they haven't succumbed to kind of mass layoffs yet, that's even further reason to say that they have financial strength as they kind of move through trying to survive these events. So ultimately, I think, again, we talked about it, the stock over 5% up today. Investors seemed happy with the results. If you're Warren Buffett, you have to be thinking to yourself, I wish I wouldn't have sold, right? And I'll tell you, when I heard that Warren Buffett had sold Southwest, that was a big reason why I personally did not want to buy this stock when it was in the low or mid $20 a share. As Warren Buffett is famous for saying, investing is a no-called strike game, which means if you're playing a baseball game and you have 3 perfect pitches go by you that you could have swung at and you sit there and you do nothing, you're out. You got to move on, okay? But that being said, in investing, you could sit there and have 100 good ideas come your way, not swing, and swing on the 101st when your gut tells you it's the right thing to do. You knock it out of the park, and you know what? You weren't called out, you know what I mean? Like for the first 100 you didn't swing at. So that's a huge, huge advantage with investing. You don't have to force anything. You can wait until you are comfortable with the deal. And at that point in time, like I said, I wasn't comfortable going against the Oracle of Omaha. But that being said, clearly it would have worked out to have done so. So what do you guys think about these quarterly results? Were you guys just as excited about it as it appeared the average investor was, sitting the stock up over 5% today? Are you going to be buying more? Do you currently already own the stock? Are you thinking that you're going to sell because you think maybe it's kind of topped out in the short term? Let me know in the comments below, and thanks for watching.